Good afternoon. My name is Bhavya Gupta and I'm here with my team.
Iqbal,
Tina,
Anunay, Ritesh, and Levin.
We've gathered here under the guidance of our respected professor, Cherish John Joseph, and the agenda for today's interview is to interview Mr. Tushar Kansal, the CEO and founder of Kansaltancy Ventures, and get to know a brief about how he chose venture capitalists as his profession and get to know first-hand experience about how the industry of venture capitalists works. So if you could, to start off with this interview, could you please just give a brief introduction?
Yeah, I'm Tushar Kansal, 21 years of experience post my MBA. Did my engineering, then did my MBA in finance from University of Delhi 2001. Have been very fortunate to have worked in all core areas of finance. Have been part of the financial advisory and private equity practice at Deloitte and Touche. Was part of the team which invested 100 crores across companies at Brand Capital. And then I was in central treasury at the telecom company Aircel. So I learned investments and raising funds. And then I was heading treasury at the Russian telecom company MTS. Raised almost $3 billion for them in 3 years as debt. And lastly, I was CFO of a company owned by Guggenheim Partners, the American private equity fund. There I learned what is private equity reporting. How do you report to a private equity fund? Kansaltancy Ventures was started 7 years back, and I have personally invested in 5 companies. I am also a venture advisor with Loyal VC, which is a Canadian venture capital fund led by NCR alumni, and we have invested in 220 companies across 50 countries. And more than 35% of our companies are led by women. We have a core area as diversity, and we do follow a lot of ESG norms, which are environmental, social, and corporate governance. And 4 months back, we were awarded as the best startup supporter by Dr. Kiran Bedi at the event by ICRA. And I've done more than 250 webinars and events, and I keep on going to academia because that rejuvenates me. And this is about me and the company, and it's an ongoing journey, but the best is yet to come.
Thank you so much for such an introduction, sir. Getting to know about your vast experience and work experience, we are really eager to learn more from you. So to start off with the questions, I would like to ask you, so what made you choose venture capitalists as a profession?
See, there is a personal reason and there is a professional reason. The personal reason is that I have always been a voracious reader. I have been reading 2 to 3 hours every day since school time. And the more I read, the more I understood how the rich make money. And that is a professional reason. So if you look at the tax structure of different economies, in the US, the capital gains tax is 10 to 20%, which is levied on if you are investing in shares and stocks and venture capital. If you are earning income from a salary, your income tax is 40%. So clearly they are telling the rich people, earn by investing your money. The same is true for Singapore, the same is true for India. Singapore is 15% capital gains tax and 20% income tax. India 30% income tax, 10 to 20% capital gains tax. So the second part of it is that because the economies of the Western countries, they are very reliant on cheap availability of money. Money should be easily available, otherwise their GDP does not grow. They immediately come to a recession. So that's why they have been printing a lot of money and providing it as debt to companies and governments across the Western world. So because there is so easy money available, the interest rate is very low. So if you park your money in a fixed deposit in a bank, you hardly get anything. You get 0.5% in 1 year. But the corollary to that is, it is cheap to borrow that money for 0.5% and invest it and make more money. This is what has been happening since almost 30-40 years now. Companies come up, they borrow money at 0.5% per year, which is hardly anything. And the leverage allowed is 90%. Hedge funds, they put $10, they borrow $90. So you have $100 and on $90 you are paying only 0.5%. So you invest that money across different asset classes like real estate, commodities, oil, gold, cryptocurrency, stocks, shares. You invest it across different asset classes and then you make a return on that. And since everybody is doing it, 50% of their economy is services led, and everyone is borrowing money and putting in asset classes because they are not doing manufacturing. They have already outsourced manufacturing to China and Vietnam and Bangladesh and India. So the valuations are high because everybody is borrowing that money and putting. So we have bubbles. So we have bubbles in stock markets, and the size of US Treasury balance sheet increased from $7 trillion to $31 trillion from 2008 to 2022. In 14 years, they printed $25 trillion worth of currency. All that money is just in different asset classes, and because of the easy availability of liquidity, venture capital is a very attractive class. And that is the professional reason, and the personal reason is that I have been a voracious reader, so I always knew what others are doing, and finance and technology is the past, present, and future. So I made a role for myself in finance.
Thank you so much for the insightful answer, sir. Sir, I would like to ask one more question. As you have an experience of 21 years, so sir, would you like to highlight any key difference that you think is that every new venture capitalist would face in today's day that you might have faced in the previous years, in your initial days? Is there any basic difference with the time that has been forwarded?
Yeah, I mean, India was very poor in terms of availability of high quality Wi-Fi. And if I remember 2008 onwards, internet speeds were hardly anything, and it was very difficult to get a good internet connection, a high speed internet connection. Jio came in, and we have become the largest data consuming country in the world, the lowest rate. That has enabled the proliferation of smartphone as a platform for companies to grow, utilize the smartphone as a platform, and that has led to a huge number of consumer B2B and consumer B2C companies. And one phenomena is Geo, the other one is that the government started Startup India scheme. And in 2016, there were hardly 436 companies registered in the Startup India. Now there are more than 75,000. And this year, I think 40 unicorns got created in India. Unicorns are companies with valuation of more than $1 billion. And India has right now 107 unicorns. So the speed at which we are adding unicorns equals the speed with which China was adding unicorns when it was growing at 13% in 2006 and 7. So we are at an inflection point, and everybody is saying that right now we are $3.5 trillion economy. Everyone is saying, including the world's best economists, that India will become an $8 to $10 trillion economy in the next 6 to 10 years. We are the 5th largest, we'll become the 3rd largest. This is an opportunity of the size of China, because we are also about to be the most populous country on the planet. And because of the excellent policies of the government of India, the world right now is although in a recession. US is in a recession, Europe is in a recession, Japan is in a recession, China has a lockdown issue because of their anti-COVID policy. But India is a calm ocean amongst a very turbulent world. And world over, the inflation is huge because the governments distributed money during COVID. And because of that extra money in people's hands, the value of money went down. So inflation came up. So things are becoming costlier. So that has led the central bankers of the world, the Federal Reserve and the European Monetary Authority, to raise interest rates, to curb inflation, to curb demand. So because they are raising interest rates, the prices of assets are falling down. The Nasdaq and New York Stock Exchange is down by 30%. But you look at India, our Sensex is still 60,000. It hasn't fallen down. The reason is because inflation in India is under control. And the why inflation in India is under control is because the government of India, Mr. Modi, he was advised by the Western politicians to distribute money during COVID. He did not do that because he knew that in bad times, if you give money to Indians, they save it. So that money will never come out in the economy, it won't get added to the GDP, it won't get added to productivity. So instead of distributing money, he distributed a very small amount, $2,000 per month to very poor people. That is, but he distributed food from the government godowns. So 80 crore Indians are right now, since the last 2 years, getting food from Food Corporation of India. But because of the excellent policies of Mr. Modi, inflation in India is very benign. In spite of oil prices rising because of Russia-Ukraine war, but in India is an oil importing country. 90% of oil is imported. But still, inflation is under control. And that has led to good GDP growth in India. And so, you asked me what has changed in the last 12 to 14 years. The way in which economy has progressed has really, it's really amazing. Inflation is under control. There is a continuity of policies of the government. It is not like governments change and policies change. That gives a lot of comfort to the foreign investors also. Stock markets are at 60,000. And we have good internet speeds, good infrastructure. The world has changed for India.
Thank you so much, sir.
So, sir, before investing in a company, what are the key points you will look upon a company?
And the basic mantra is the same, which was 40 years back. First is the current status of the company, of the business. What is the current business? How fast is it growing? The second thing is market size. If you have an excellent founders in hand, an excellent business, but the market size is suppose only 50 crores. So even if the company fires on all cylinders and takes 50% of the market, its turnover will be hardly 25 crores. But venture capital funds typically want to be in a company whose market size is at least $5 billion. Because the upside should not be limited. So second is market size, and the third thing is the funding ask. How much funds you are asking and how will you use it to generate the top line. And amongst these three factors, current business, market size and funding ask, there are sub-factors, so those are more detailed, like category tailwinds within the existing business. So if you are in a particular area of a particular sector, how is that sector doing right now? Is it firing on all cylinders? So COVID came, all the academic institutions, they jumped on online classes. So the online classes as a category boomed. So whether that particular category has tailwinds. So then there are things which are under these broad three heads.
So, like comparing to any other market, India has a 1.2 billion population, right? So the market is like really diverse.
Indian market is very fickle. It's very price sensitive, it's service sensitive, it's quality sensitive. An Indian guy has so much of time, he will talk 20 minutes to buy something which can be done in half a minute. So he'll talk to 10 people, know the price, compare the price, then compare the quality, then if it is not good, he'll return it back. So, about product market fit. We talk about product market fit. Like what is the fitment of a possible product, which includes pricing, distribution strategy, manufacturing. So a PMF which is created in Indian market is valued across the world. Because अगर आपने Indians को बेच के दिखा दिया, तो आप दुनिया में किसी को भी बेच सकते हो. Indians are the most difficult customers. Second part to it is that although in terms of population we are 1.2, look at our purchasing this per capita what do you call it, income. It's I think 2,000 bucks, right?
Purchasing power is very less.
It's 2,000 bucks. So
But capital income is also comparatively less.
yeah, so the thing is, if there is, how do families spend? If they have a particular money, they spend first on education, on food, then they spend on house, then they spend on clothes, then they spend on discretionary spends, which are education, first education, then health, right? The sequence is this only for Indian family. So, where is the scope of providing more products and services to the Indian family when COVID has just happened? So if you look at the market of companies which got funded 10 years back, you look at their market closely, you will find that the segment who they are addressing is 5 crore people out of 140 crore people, 50 million. 50 million is the middle class in India. People say it is 300 million, it is 400 million, it is 500 million. You talk to any company which got funded 10 years back, it is 50 million and not more than that. The purchasing power beyond 50 million falls off a cliff. And so, how do you provide? Zomato started 10 years back. It is a funded company. Till today, it is in losses. Now it is charging 40 to 50% commission, but still it is in losses. Why? Because price elasticity. Because for most of the products, it's very difficult to increase the price unless you provide some premium to it. And the moment it goes premium, it falls outside the purview of 135 crore people out of 140 crore people. So look at Byju's, 2,500 crore revenue and valuation is 90 times revenue. So how is he running the company? I mean, it is in losses. I think it has a loss of 4,500 crore. It's the most premium education company in India, funded. And how is it running? In losses. Why? Because this is India. So you have to accept losses, otherwise you won't be able to capture.
How do they manage the fund? Even the aviation sector, even the Byju's, after like making such a huge loss, I think they appoint the Lionel Messi, the football player, the top football player, as the ambassador, global ambassador. That cost them millions. So
all the investors are foreign, right? I mean, the investors in sitting in Byju's are all, money is all from US and Europe.
And they laid off thousands of people too, right?
yeah.
So they
And
saved
they understand only Messi. So that is why they hired Messi. And main thing is, what happens is like Alibaba was a very small company, right? It got funded. I'm giving you an example to compare China and India. The moment it got big, the valuation boomed. And the valuation used to be arrived from a top-down basis, not a bottom-up basis. So the Chinese economy is this much, the top 3 companies are this much, so their value is this much. India, GDP is this much of China, top 3 companies, so they should be valued this much. So there's a premium. So what happens is that if you have market share, you have a huge premium which the investor is willing to give to your company. But end of the day, you should have cash to run the company. You should not be so stupid to not raise cash at the right point in time. If you run out of cash, you might have to close down.
So I'd like to add I'd like to ask one more question. As there's a cash burn practice as well that is followed by startups. So at what time is it suitable for the company to realize that in order to survive in this business, this sector, to follow that going concern business principle, they need to stop with that cash burn practice and start changing their prices in order to make profits? Because they cannot survive with doing the cash burn practice for so what say for around 5-6 years, because that will result in increasing number of losses for the companies.
It's the same thing, right? I mean, Make My Trip has been in the business since 25 years, 20 years, and they have 40% market share. They are the number one. Second is Yatra, which is way behind. Make My Trip got listed on New York Stock Exchange. So they have no issue of getting money. Money is not a problem. They don't want to lose market share because that 40% market share gives them a huge premium on the valuation. So if they were to raise prices, India is so price sensitive, they will immediately lose market share. But funding winter is going on and there is a problem and deals have slowed down. Valuations have come down by 22 to 28%. And look at what happened to FTX just 3 days back, from $32 billion to bankruptcy within a matter of 15 days. So Warren Buffett had said, when the high tide goes and the low tide comes, then you get to know that who was swimming naked. So now funding winter is going on. Even governments are facing a problem. Sri Lanka defaulted on all its loans. So those who are not managing their cash flows properly, they are facing a problem. Money has to come from two places. Cash comes from two places. Either it comes from the customer or it comes from the investor. If you have not raised money in advance and kept 12 to 18 months of cash burn on the side for this harsh time, you are going to get it. And those who were wise like Byju's, they already raised and they have good amount of money sitting, but they are still retrenching because they need to lower the cash burn to survive this time. You can imagine how much of money is out there that, as he said, that in spite of the huge losses, they are still continuing. That's the amount of money which is looking for assets to invest, looking for a return. For India, interest rates are always 5-6% to RBI sets. Bahar it is 0.25%. So the options in front of any billionaire is very less. How to get return on this money? The options are very less. That's how two countries come into the picture in the world. Both of them combined have 40% of world's population. China and India. China is right now in a mess because of its zero COVID strategy and the lockdowns and the slowdown also. The only shining economy is India, which is giving 6% GDP growth, 7% GDP growth, and inflation is under control, and public finances are good, and survived COVID well. So that's why they are flocking towards India. That's why we had an FDI of $84 billion last year. We never thought of it. India can get $84 billion. That's how things are.
So all the company you invested in turned out to be profitable?
No. I am an angel investor. I invested early. So angel investor takes the maximum risk. I don't have the ticket size to invest in late stage. So I invested early. But I've been in this business in 7-8 years. So I was telling her in the morning that sometimes you meet a person and immediately you get that feeling that this guy has the X factor. So as soon as you meet, within 1 hour you'll get to know this person is serious about life, about what he's doing, and he has a mission. And that's how I have invested, because when you invest early, there are hardly anything on the ground to see. You can probably see a little bit, some product, some shape of the product, so it's mostly a bet on the founder. You're betting on the horse, right? So I took that decision of investing in these companies because they were creating something different. And for example, one example is that one is a robotic company. So they have created 4 types of robots, and the most interesting robo is it does robotic scavenging. So the cleaning of municipal sewer lines, it's being done by humans in India till today. and many people die because there are methane and other gases there. So Supreme Court has said that to stop manual scavenging. So this company has come out with a robo which cleans the municipal lines. So I thought it has a huge use case of the robo. That's one example.
Did any of the company you invested in end up in failure or?
Yeah, so I invested in a company called Brillix. Both the founders were from Unacademy, 23, 24 years of age. One of them was on a salary of 75 lakhs. The other one was on a small salary. But both of them were picked by Unacademy when Unacademy was very small. And they picked them because both of them came from weak backgrounds. And both of them from their towns or villages, they had created YouTube channels through which they were earning by showing academic content. So they were very promising, both of them. So Unacademy picked them, and in 2-3 years their salary at the age of 24. So they were achievers, not academically. One of them is academically also a big achiever. And when they left Unacademy to start a company, so that's when I took 15% equity. And one of the VC fund guys had told me, Tushar, you are making a mistake, because they want to create a technological product. They wanted to create an app, and that also a socio-edtech app. So Facebook plus Quora plus WhatsApp plus Baiju plus OpenSea. They had a token also. All things mixed. So they said the vision is good. I mean, they told me privately. They didn't tell in front of those two. They said that the vision is good, the requirement of this kind of a product is there. And these two are very well qualified. But they are not technological people, and they are wanting to create a technology product. So this will fail, because these technology products, they require a lot of understanding of each small thing. Each feature has to be very well thought out. So I thought, yeah, maybe, I mean, this big fund guy, $850 million guy is telling me not to do that. But I did that. And then further 2 people invested more money. But it went on. So after it got launched, we had certain milestones that they will achieve this many daily active users, DAOs in this much time. So they kept on achieving that for the initial 2 months. Then it slowed down. Then it further slowed down. And within the 4th and the 5th month, the new investors who were there, they said we are not putting any more money because they are not achieving the targets. And so both of these guys started fighting. It's your mistake, it's your mistake. Then they retrenched the whole team and the company shut down. Everything gone. Product is still there, but there is nobody to look after the product. So it's no good. That's my experience.
So, can you explain in general, some of the factors that can lead to the failure of a company?
It's there, the research is there. I mean, a lot of research has happened. 43% of, 92% of startups, they close down in the 2nd and 3rd year of operation. Out of that 92%, 43% closed down because they created the wrong product. Because probably it was done by techies and not by someone who understood the customer. End of the day, customer is the king. Even if you have a wonderful technology, if the customer is not willing to adopt it, customer is not willing to pay for it, it goes down. In no time, it goes down. And that's what Steve Jobs also said, right? I mean, it has to suit the customer. So 43% of startups close down because they create the wrong product. And their problem statement might be good, but their solution statement is not there. That's why we say that creating a minimum viable product, MVP, is not the most essential thing. The most essential thing is to create a product market fit, a PMF. take that product to the customer, do primary research, do secondary research, find out how much he's willing to pay for it, get him to tell what things he wants changed in the product as soon as possible. So 43% is that. Second is follow-on rounds don't happen. There are many companies who have raised first round, second round, but third round does not happen. Again, the reason is India is a difficult market, even for investors. And the reason is that till 1 year back, see, the best way investors want to exit is through an IPO. Company का IPO कर दो, the shares will be traded every day. तो कभी भी बेचना बेच दो. Market is doing good, shares are up, you sell. That's the best way. Now, stock markets are regulated by SEBI, Securities and Exchange Board of India. SEBI has been a very conservative institution in the sense that it had many clauses for any company wanting to do an IPO. For example, one clause was that you should be making profits in the last 3 years before listing in an IPO. Now you look at all those startups, we are talking about these startups, they don't have profits. They are into losses because they are in the investment phase. Money is still going in and getting invested. So, but SEBI changed that. And that's why the IPOs of Zomato, Zomato, Paytm, Policy Bazaar, Nykaa, all these IPOs happen.
Sir, after you have decided to invest in a company, what are the follow-up procedures that you need to undertake?
So there are two models which one can follow. One is that you invest the money and you have bi-monthly or once in a month reporting. That reporting is basically the financial numbers for this month and the cash flow. So the cash flow is the most important. That the company should give you real-time cash flow. They should have a dedicated resource which gives you real-time cash flow. What is the cash situation in that company? Because we as an investor are really bothered that the company should not run out of cash. Because we make 10 investments, we understand some of them will not do well, but we have put in the same amount of money and effort in all the companies. So cash flow is the most important. Second thing is we need to be very aware as to how our money is getting used. So there are things in India which are practiced by the banks also. Like they ask for a CA certificate. But CA certificate is very easy to get. Any CA can just sign it, take some money. But you know that the money was spent like this. So we can have an escrow account from which the money will be used, and we can monitor the escrow account. But it is not possible to do it for so many companies. So end of the day, you have to give flexibility, and whatever rights you want, you should build it in the agreement, the shareholders agreement, to protect yourself. And the second part is a model which is practiced by a large number of funds, which is the one followed by Guild Capital. I was just talking to her in the morning, telling her about Guild Capital. So they have a model wherein they don't want any situation where the company does not have support. So they have their own digital marketing company, own legal team, own CA, CS, taxation, own co-working space with Wi-Fi, and they have a place where industry mentors can come, address the investee company, mingle with them, and in case the investee company wants to take that person for a longer assignment, then we can compensate that mentor by giving some equity and giving some monthly amount. So that is the second model. But frankly speaking, three things are basically required by any investee company. One is network, which means they want to get business. Now imagine if you are a 5-star, okay, you have a small shampoo bottles and you are taking it from a known brand. Now suddenly a startup comes, we will provide you organic shampoo and we will bottle and brand it for you. But how can you trust that company? Right? Because they are new, so they don't have any credentials. So that's where the role of investor comes in, that we give our credentials and we have invested and we are a institutional investor. So one is that. The second thing is market making. You have to ensure that the other investors, they invest in the follow-on rounds of the company, because if the market making does not happen, then the company will close down or it will just become a normal company. It won't grow. So a lot of times we are like a fruit market. So we go to other funds, we tell them we have invested in these 10 companies. You show us your investment, we show you our investment. You invest in our company, we invest in your company. So that is the way market making happens. A lot of give and take happens of the right kind. So that happens. And the third thing is, one is network, one is domain knowledge. So again, mentors, as I said. Now a couple of funds I know, they have different approaches towards domain specialization. One is that they hold an international offsite and they call the investee companies of all their funds, whether it is outside here, in an informal atmosphere. And they discuss what problems you are facing, how we are solving the problem, and you can probably use this technology, it is easily available, this is the price. And the second thing is, for India, I know a fund which calls all its founders of investee companies to a spiritual retreat. You must have heard of Neem Karoli Baba.
Yeah.
The Neem Karoli Baba's ashram was visited by Steve Jobs and Mark Zuckerberg. Now he's no more. So they take their founders to Neem Karoli Baba ashram, and in the evening when you are sitting in a hill Himalayan place and you are informally talking, so you can easily understand what is the psyche of the founder and whether he is motivated enough and where is he lacking. So that's how I mean, these are the strategies of it.
I would like to know, sir, how do you keep a regular check on the company in which you have invested?
So as I said, I mean, you can protect yourself by clauses in the shareholders agreement. That if anything, so there are different type of clauses, and so some clauses are restrictive. For example, there is a list in the annexure. If any of those events happen, the company has to take my permission. Like if they are selling a big asset, if they are recruiting a costly CXO, if they are entering a new market, if they are taking follow-on funding, valuation, all these impact me. So we protect ourselves through the agreement, but we do understand it's not a legal is not the perfect solution. Till the time things break down, then legal is the solution. So we keep on having these regular twice a month offsites, and we take the cash flow feedback and the financial feedback, and mostly it's about that, meeting the top team in an informal atmosphere, exchanging ideas, and taking the cash flow reporting and the financial reporting. Majorly is that.
So why is cash flow more important than the capital appreciation?
See, cash flow, if you talk to any CXO who has grown his business. I was recently talking to this guy. He's the Asia Pacific head of ASICS, the Japanese sportswear. And under his watch, the turnover of APAC region Singapore, Vietnam, Cambodia, Indonesia, India, and Bangladesh. All this region went from $5 million in 2014 to $300 million now within 7-8 years. So we were talking, he's a good friend, and he said that, I'm giving you an example, that behind every good CEO is a CFO. So you have to keep your eye on the cash flow. Main thing is, office rent is there, salaries are there, they'll have to go. But if your business development team is not bringing in the top line, then the cash flow becomes negative. That means you'll have to either not compete well with your competitors, or you have to ask money from the head office in Japan. Both these things will be bad for your career. So he keeps an eye on the cash flow. He knows each number about the company, how much they spend, how much it costs to do what, and everything. When COVID came, he immediately shut down a large number of retail outlets and renegotiated the rents and saved cash. And that's why he has survived. So, as an example, so cash is reality. Revenue is vanity. And the king is cash. So that's the business.
So, by any chance, if you want to sell the equity of the company that you invested in, then what is the procedure for that?
So for selling the equity, as I said, we do market making, right? That's what we do. We keep on talking to investors and in our trade, like between you and me, there is a herd mentality. And if a person is putting in EdTech, then there will be 10 more fund guys putting in EdTech. Because it also gives a lot of comfort that 5 people invested. So, each of them take comfort from each other. And it also helps in saving your job. Because if the decision goes wrong, you can always say that 4 more people invested. I was not the only one. So there is a herd mentality. It is not only in India, it is global. So when a sector comes up, then everybody rushes towards that sector. So right now Web3 is going on, cyber security is going on, EdTech has gone, FinTech India is huge because UPI like 7 billion transactions, maximum in the world, ahead of China. FinTech is huge because of the India stack, Aadhaar, UPI, and EdTech is gone, and Agritech is always very loose. Because it's very unorganized, and the farmers in India, they have very small land holdings, choti, so they can never buy costly equipment. So that's why somebody has to do the bad job of aggregating farmers, and they all are uneducated kind of, so it's not easy. So Agritech, a lot of work has happened, but adoption at massive scale will take a lot of time. And farm laws had come in, they were very big plus for the Agritech, but they are gone because of the unrest. And health tech is huge after COVID. People have memory loss issues, people have heart issues, people have stamina issues, eyes are weak, and COVID has left a huge impact on people's health. It is not coming out in the media, but you often see somebody dying in the gym, which was not earlier. So it is because of COVID. And so health tech is good. Basically, use of technology in a meaningful way, and preferably with the smartphone as a platform.
So how do you support the startup other than the financial investments?
We would like to support more, but we are not the types of great capital which have separate veins to help startups. That is also more of a accelerator model. Accelerators, you go to accelerators, right? They offer you co-working space. They offer you Wi-Fi, CA, CS, law, mentors, and we are not like that. We are a small VC fund. So we do help more in terms of domain knowledge. That we do, and we also help in connecting with other investors. So we give references, and frankly, we would like to do more, but we are a very small team, so that's a little bit of constraint. Maybe in the future we will do more.
So, can you please explain the significance of venture capitalists in the current scenario, like the scope of the venture capitalists in current scenario?
So you know, the Ryan Murthy, the founder of Infosys, he was the first one who people saw, middle class. And middle class said, you can become a multimillionaire by using your knowledge. It was the first time. Because prior to that, either you have to open an industry or set up a manufacturing, or you have to be in the arms of government or do a government job. So this technology boom which has happened, especially after Jio 2015 and Startup India. Now young people like you are all so aware that it's a viable future. You can build your own future, and the field of possibilities has opened big time. And you are so aware the Shark Tank has brought investing into people's homes. And since 2008, what has happened is that I told you about this $25 trillion worth of money which was printed by the US alone. And Japan also printed huge money, Europe also printed huge money. And all that money is chasing returns. We don't see it in India that much, but if you look at the media, you can see the number of unicorns. They are now more than 107. So, and entrepreneurship cells have opened in all the colleges, private and government. So there is a huge difference which has happened. And even you look at the background of those companies which have become unicorns. All of them are from tier 2, tier 3, and they did some education from some good college. So I think a huge difference is there. And venture capital is important because ideas, they need money. And end of the day, if you're investing in stock market, it goes up and down. If you're investing in commodities, it goes up and down. The real estate has been down since 8 years, now it's rising. Everything goes in cycles. But venture capital is in the hands of private investors. So the valuation does not come out in the public. So it can actually stay high for a longer period. So that's the benefit of venture capital. And those who invested their money in a fund, like Sequoia के fund में आपके पैसे डाले, and Sequoia happened to invest in WhatsApp, and WhatsApp got sold for $19 billion to Facebook. So that money will get returned to you also, right? Sequoia will cut only 20%. 80% will get returned. 50 million का WhatsApp खरीद के 19 billion का 2 साल के अंदर बेचा. कोई और asset class है जो 380 times return आपको 2 साल में देगा? कोई भी नहीं देगा. Failures भी बहुत, 90% बंद हो जाती है. But beauty is that it goes exponentially. Because valuations are always multiple of the profit and loss, of the revenue, of the EBITDA, of the net profit. That's the beauty of venture capital.
So my next question is what are the daily activities that you carry out as a venture capitalist?
See, most of the time we are reading because we have to understand the headwinds of each sector. So we have to track the sector a lot, and all the money available in venture capital most of it, 90% is from the developed economies. Pension funds, endowment funds. Like UK has DFID, Chanakyapuri, that's UK government money. Then you have DEG of Germany, Vasant Vihar, that's also German government money. So all that is very patient money. They will not ask you for the return till 8 to 10 years, but they will ask you for the return because that is government money. So if you don't give them the return, your follow-on fund will not get funded. So your career goes down. So daily activity is you keep on reading about the sector, you talk to founders across the board, and keep on having an eye on any exit possibility, and keep on talking to your founders and see how you can get the business. Mostly it's about and also we have Excel sheets where we calculate what is the valuation of each company. So that's called mark to market, which we have to do for accounting. So we keep an eye on that. So recently you would have heard in media that SoftBank did a down mark to market, almost 30% down because of the market. And because of that, Masayoshi Son, he had to sell his Alibaba investment, which was his best investment. So all those accounting norms are also there.
So thank you so much for all the answers that you gave. So at last I would like to ask you, do you have any suggestions for us on how can we go into, if you want to get into the field of venture capitalism, what is the right path for us? If you could give any suggestion to us.
Right path, the best way to get into venture capital fund is either to have your own funded company. One is academics, second is reference. Academics can be CFA with BCom, or you can also do MBA from a very good college along with BCom. And you can initially join an Indian network or a accelerator. So you will get the knack of holding events, having these events, exchanging cards. Also, you first identify what do you want to do, and you write blogs about it. Right? Now, if you want to become a VC, I am a LP, I am a limited partner who puts money in VC. Why should I give my money to you? Why should I not give the money to Mr. Manoj Kohli, who heads SoftBank in India? He's offering me 15% return, you will offer me 20% IRR, internal rate of return. End of the day, I trust somebody who has already done it. So you have to build reasons why should anybody give their money to you. So maybe you understand the sector so well, you have written the blog so nicely, there social media people are talking about it, then you add all the VCs on LinkedIn, they say you join us. So academically you train yourself, skills wise, CFA, MBA, finance, from a good college, BCom with BCom, or become an entrepreneur, even if you fail. And the second thing is you should be visible, exchange cards. I know this guy Fazlur, he used to come to me, teach me VC, and we used to talk. What he did was, he started talking and meeting VCs, understanding their financing structures, and putting out social media posts on any particular thing he understood. Like contribution margin, he understood what is contribution. He'll make a post, he'll explain the whole contribution margin with an example. He has been doing it since 3 years. Now he has joined an angel network in Mumbai. 31,000 followers he has. So there is no fixed way. There is no fixed way in life. There is no fixed path. Rishi Sunak has said that politics is also an option. So there is no fixed way, but to my mind, this is a good way.
Basically, networking is the key.
Networking and being seen, and also knowing why you want to do something. Like this guy in Bangalore, and you've seen the floods which happened recently in Bangalore. They were because Even in the areas where lakes should have been there, they built apartments. So this guy started creating ponds and used to tie up with corporates that any corporate has a land, I will turn that into a pond. So first clean it, then dig it, then make a water supply, create a pond, then hand it back to the corporate. So he did that 2-3 times. Now companies are funding him to create ponds. He has created 40 ponds. He's called Pond Man. He calls him Pond Man. So he's getting the money. So that's his calling. So you should know why you want to be a VC. Don't be in it just for the money, because it's not easy to get a return.